Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're going to revisit IFRS 3 business combinations, and we've got a new face in the podcast studio, Avni Mashru. Welcome, Avni.
Welcome. Very excited to be here. I'm an avid listener.
Oh, that's good. Well, you're my one. In the analytics, you're my one listener.
Me.
Welcome back.
I'm your one subscriber on iTunes. Yes.
You can go and listen to it afterwards.
I will.
Get your mum on there, that's two. Okay, so we have previously talked about IFRS 3 before with Mary, and we mainly focused on definition of a business because obviously it's one of our big changes coming up. I think what we thought we'd talk about today is maybe break the standard down a little bit, look at some of the basics of how you do a BizCom and then some of the areas you see where people go wrong. So let's start at the beginning. High level, easy question. How do you account for a business combination?
Okay, high level. I'm gonna use really basic terms because I like thinking in just very basic. So a business combination, in terms of the accounting for, and a business combination is just another fancy way of saying one company potentially acquiring another or merging with another, however you might phrase that. The accounting works as how much did you pay? What did you get in return in terms of assets and liabilities of the business? What might be the part of the business that you don't own and something referred to as non-controlling interest? And then you end up with something called goodwill, which is the difference between what you paid, what the business is worth in terms of assets and liabilities, taking into account the bit you don't own, and that residual piece is that term referred to as goodwill.
Okay, perfect. Or how I like to think of it is just like you made a bad deal. You should have put all of that as an expense. Sometimes. But that's not right. It's definitely an intangible asset. Okay, perfect. So basically what you're paying against what you're getting, and then you've got that funny thing called non-controlling interest in the middle. So what you're paying is effectively your consideration, I think, term in the standard. Now, let's go through some of that. So what are the tricky bits of consideration?
So consideration, and IFRS 3, the standard that tells us about business combinations, the last sort of significant rehaul of that was about 10 years ago now. And the big change with that, one of the big changes on the consideration piece of this was to say, well, consideration is only the amount that you have paid to the seller of the business to gain control. So the really obvious piece is you might pay cash to acquire the shares of a business. Yeah. That is consideration. Yeah. Some of that amount, so you may pay cash, and then you might have an additional amount that's contingent on future performance or future profits of the company. And again, that will also be part of your consideration, and it's called contingent consideration, and there's some special accounting around that. Outside of that, there may actually be other things that you pay in the context of a business combination that isn't consideration. A really classic one is transaction costs. So you might pay some lawyers, you might pay some other professional advisors to help you through that business combination, that acquisition. The amounts that you pay those people in terms of fees are not consideration in the context of the standard, because if I go back to the standard, it's looking at what do I pay the seller to gain control. Well, I'm not paying those amounts to the seller, I'm paying them to a lawyer or a professional advisor, and they're not directly related to gaining control. They help me form my decision or actually execute the transaction, but they don't they don't give me control. So those amounts previously, in days gone by, we would have considered transaction costs as part of consideration. Well, now we've moved away from that and said, well, unless it's directly payable or receivable by the seller, you account for that separately. And what happens with transaction costs, I can hear all our listeners thinking, they end up in P&L. Yeah. So you don't capitalise them, or you don't do anything special, they just go into profit and loss.
Okay. So one of the things you talked about there was contingent consideration, which is obviously difficult in terms of measurement and what people do with it. The other thing I find that comes up a lot of that is it really consideration or is it actually compensation? Can you tell us a little bit about the issues there?
Yeah. So the other scenario in terms of, again, thinking about consideration as the amounts you pay to a seller to gain control, where it gets difficult and complicated is you might pay these amounts to somebody who is a seller of the business, so is a shareholder of the business. But you may say to them, because, for example, it's an owner-managed business and these owner shareholders are very important to the business, you say, well, I'm going to give you this amount, but I'm going to make it contingent on you remaining employed with the business for X amount of time after the transaction. Now, the tricky bit there is that now we've got two things going on. Potentially, one might say is there's a bit. I'm trying to acquire the business from the seller, but I'm also saying to the seller, I want some services from you. And the standard, again, is very clear here. So it says, if you make a payment in this context and it is contingent on, or it's dependent on service, then it is not consideration. That is consideration or compensation for employee services. So you're receiving something else. You're receiving a service. It's not just control of the company. And in the early days of sort of IFRS 3, when it had this big overhaul, we had some quite not great accounting answers, some might argue, where 100% of the consideration being given to a seller was wholly contingent on future employment. And we would say, well, sorry, the standard is very clear.
Yeah.
All of those amounts you paid are not consideration for the business combination.
You got that for free.
You got that for free, effectively. All of it is consideration for future employee services. So when you come to do your business combination accounting, like we talked about at the beginning, in terms of comparing your consideration to the assets and liabilities you acquired, well, the number you now assume consideration is nil. And obviously that gives quite an interesting result in terms of negative goodwill.
Yeah.
So...
Okay, and there's a number of indicators in there in the standard on how you decide if something is consideration and compensation.
Yeah, and then one thing I would highlight here is where a payment is very clearly, explicitly linked to service. For example, the contract actually says you only get this if you provide 3 years service. The standard is explicit. That is always consideration, pretty much always consideration for future employee services. Where it's not that explicit, so where the contract doesn't really say, but
they're working there as well.
They're working there as well. There's probably some other factors too. That's where the standard then has a number of different indicators that you would then work through to say, okay, on the balance of evidence, does this have the characteristics of a payment for future services, or does it have the characteristics of consideration?
And I've even seen some where you have to bifurcate it between the two.
Ruth, you've just used a really complicated word, bifurcate.
Don't I sound clever? It's very rare that happens in the studio. Okay, and just before we move on to the next bit of the sort of equation, what with contingent consideration, why don't people like it? Why is it the thing that, really they prefer an asset acquisition?
Contingent consideration, again, it's like things in IFRS 3. IFRS 3 is very clear. So it says where you have this kind of contingent consideration, on day one, you estimate its fair value. So you estimate how much you might, as an acquirer, pay out in terms of assuming it is a payout situation to the seller in terms of this additional contingent consideration. Then what happens? Day 2. Any changes in that estimate, the effect of those changes end up in your profit and loss account.
Okay.
See, what we used to have, again, going back days gone by, contingent consideration, again, similar thing. You would have an estimate of its value on day 1, but we used to be able to take the adjustments to to goodwill, effectively to the asset side. IFRS 3, again, as I said, very clear. And there's lots of points in IFRS 3 where it's just clear on what you have to do. People don't necessarily like that answer in the sense that it does potentially result in income statement volatility in the years following the acquisition. And that's quite painful if there is some actual genuine volatility in the amount that you estimate you're going to pay. But also if these contingent consideration periods extend 5 years, 10, extreme circumstance, but a number of years after the acquisition, to carry on getting this volatility post-acquisition isn't always the greatest from a reporting standpoint.
Yeah, okay, perfect. And I think you see that in some industries more than others, don't you? Okay, so that was the consideration part. So tricky bits, contingent consideration, that difference between compensation versus consideration. Then we move into the other bit you said, which is like the non-controlling interest, the bit you don't buy. Anything there we should watch out for?
Yeah, so non-controlling interest, and again, just use a very simple example to reiterate what we mean. So if I acquire 70% of the shares of a company and I acquire control of that company, when we talk about non-controlling interest is those 30% of shares you don't own. So you have control over the company because you have the vast majority of the shares, but there's this 30% that you don't. And on acquisition, the standard again gives you 2 options as to how you account for that non-controlling interest. So in business combinations accounting, what happens is you bring the full value of the company you've acquired onto your balance sheet, so 100% of the value of the assets and the liabilities go onto the top half of your balance sheet, And you recognise the fact that in my example, you don't own the 30%, or you don't own effectively 30% of those assets and liabilities by reflecting or measuring non-controlling interest in equity. And you've got two ways you can measure that on acquisition, and it's only on acquisition. You've got two options. One is to say, well, I will represent the value of that non-controlling interest by taking 30% of just the fair value of the assets and liabilities that I've put on my balance sheet. So if the fair value of those net assets is 100, I will have non-controlling interest of 30 sitting in my equity section. Or I could say I could measure non-controlling interest on the basis of the fair value of the entire business. So say I paid 150, so in a really sort of simple, paid 150, the assets and net assets are worth, fair value of those are 100. So if I was to do non-controlling interest on a full fair value basis, I'd take 30% of the 150, so the full fair value of the business, and that would give me a 45 non-controlling interest as opposed to 30. That is a choice. So that's a choice you made just purely on day one.
Okay.
The day two accounting is the same then, doesn't matter what sort of method or option used on day one. If I'm honest, it varies by jurisdiction and territory.
Yeah.
More often than not, you'll see people use that proportionate net asset method. So the method that gets you the 30% of the fair value of net assets acquired, so the 30 in my example. Yeah. That's definitely present.
When IFRS 3 first changed, it was a big thing, wasn't it? There's a choice, what's everyone going to do? Now it seems to be like it's just a done thing.
And it is actually, it's a choice that's freely available by acquisition, so it's not a policy choice. You can change your mind from acquisition to acquisition. Again, I wouldn't say I've seen that wholly frequently either, but it was definitely, like you say, a big herald is a big change, but actually in practice not so much.
Yeah. And any other tricky bits to watch out for in NCI? Is that normally the easy bit?
That's probably the easy bit. It's more the transactions and non-controlling interest, which probably, to be honest, Ruth, is a whole
we could have a whole 20 minutes on that, baby.
Different podcast.
Okay, we'll have you back to talk about transactions of NCI at a later date. Okay, so we've talked about what we pay, we talked about what we don't own. Then obviously the standard says that you have to recognise all the assets you acquire and liabilities you assume. Any, again, tricky bits we need to watch out for in the assets and liabilities piece?
So it sounds like kind of straightforward. So off you go, just fair value everything you've acquired. And it's certainly, to say it's easy, but the things that are already on the acquired entity's balance sheet, so that the assets and liabilities you can see on their balance sheet, that's easy enough, because you can go and assess, what's the fair value of each of those lines. The trickier bit is what's not there. So the things that are not on the balance sheet today. And the most common example is intangible assets. Yeah. So I'll give a really sort of basic example to sort of bring home the principle in IFRS 3. So IFRS 3 says you must fair value all of the assets and all of the key term here, identifiable assets and liabilities that you acquire on the acquisition date. And it is an objective measure. So it's objectively saying, doesn't matter what you intend to do with these assets and liabilities on day two, on day one, at the acquisition date, what is the value of everything you've acquired? So in terms of intangible assets, not all of the intangible assets that you've acquired with and I just used air quotes there, that you've acquired with the business will be on the balance sheet. And a really good example of that is a brand. So vast majority of brands are usually internally generated within an organisation and won't appear on the balance sheet, but they're there. You might go out and make an acquisition and say, well, that's great, that company's got a brand. I don't want to use that brand. I'm going to put in my own brand. So actually when I go in and fair value, I'm just going to ignore that because that doesn't matter from me from an acquirer point of view. Standard doesn't say that. Standard actually explicitly says acquirer intention is not taken into account. There's actually a specific piece that says that. So you would be required to fair value the brand at the acquisition date. What would probably happen in that scenario for those thinking, well, what does happen on day two? Absolutely, on day two, if you intend to completely disregard that brand and not use it at all, you will have an impairment, a full impairment probably in that case, at day two. But on day one, you must acknowledge the fact that you did acquire a business that did have this intangible asset in it as at the acquisition date.
Yeah, so I presume you can't say the fair value is zero.
No, you can't say that either. And again, I still get that question to this day. Yeah. Less so now. I think people are coming around to this concept of I must fair value everything I've acquired. But there is this instinctive gut reaction of, well, it's got no value. Surely it must be zero.
Yeah. And any missing liabilities?
Liabilities tend to be less so. The one that you will hear about, certainly it's talked about in the standard, is contingent liabilities.
Yeah.
So it says you must fair value all identifiable assets, liabilities and contingent liabilities. It's not all types of contingent liability, only certain types of contingent liability that you then have to recognise a liability for as at the acquisition date.
Okay, perfect. Moving through, so we've done the assets and liabilities. There's a section in the standard that talks about separate transactions. So transactions that you might pay for, but actually they're not part of the business combination. So we've sort of talked about acquisition costs earlier and compensation. Any other ones there to watch out for?
Yeah, I mean, the other one I would come back to, and I will reiterate this for our listeners, the reason that we have the separate transactions guidance is the fact that in IFRS 3, again, this concept of consideration for the business combination only being the amounts that you transfer to the seller to acquire control. And then the standard goes, lots of payments might happen in the context of the business combination because it's just that kind of transaction, and you have to sit there and separate out these transactions that really have nothing to do with the business combination. So obviously we've touched on the two sort of major ones that the standard specifically calls out is, as you say, employee compensation and transaction costs. There is a third one around pre-existing relationships. And what that covers, and again, this is one that actually we could probably do a whole separate podcast on. It's very tricky. But the concept I would urge our listeners to bear in mind is this is looking at scenarios where you go out and you acquire a company, but actually you already have, for example, a trading relationship with that company. Now, by virtue of the fact that you've gone in and you've acquired that company, that trading relationship now automatically becomes intercompany. It cancels out. And it, again, in days gone by, would have gone, no, that's fine. That just collapses. We don't need to do anything about that. IFRS 3, again, when it was revised a decade ago, said, well, hang on a second. You're doing two things here. You've got obviously the business combination, which is acquiring control of this company. But actually, you've also, by virtue of doing that, you have settled this pre-existing relationship, this pre-existing trading relationship. And in normal life, you wouldn't just settle a relationship for no money whatsoever. If you were going to terminate a relationship, there would either be a payment you would make to the acquiree, in this case, or a payment the acquiree would make to you, depending on which way this relationship is going. So you can't assume the fact that, for example, I've paid £10 million or $10 million to acquire this company, that is wholly just to acquire control. Actually, some of that 10 million payment relates to the fact that this relationship's being settled. So you've got to carve out an amount or figure out how much of that amount relates to settling this pre-existing relationship. And that, again, was an entirely new concept. Still confuses people to this day, and says a whole other podcast. But I would urge sort of listeners again to bear in mind that any time you have an existing trading relationship, a loan relationship, even sometimes a legal case, all sorts of things, do bear in mind that there is a section in IFRS 3 that talks about separate transactions and pre-existing relationships.
Yeah, that's whenever I've seen that come up, that's always been a tricky one that we've debated for a long time. Okay, so then we've got the balance going to goodwill, and we've done podcasts on impairment, and I think Mary, when she came in, talked a little bit about gain on bargain purchases as well. So we're coming towards the end of the podcast now. What I always like to do as well is anything going on? Are regulators specifically looking at this, or what's going on at the board? Could you give us a bit of an update?
Yeah, absolutely. So regulators on and off do pick up business combinations as a hot topic area, and it tends to vary with market activity, and we're sort of starting to see a pick-up in M&A activity, and hence, therefore, the regulators are interested. So ESMA, the European Securities Markets Authority, recently sort of talked about priorities, picked up the fact that they are interested in focusing on IFRS 3 again, and actually one of the points they pick up, interesting that they do this, is this employee compensation consideration point, which you think, well, this hasn't really changed over the last 10 years, but clearly there is some concern potentially that perhaps there are certain acquisitions where that point is being missed. The other thing that they're quite, or will be quite focused on, is this point around intangible assets, so making sure that companies are separately recognising all of the separable intangible assets that they should be recognising, and again emphasising to preparers that they must make sure they recognise all of these intangible assets. And then disclosures. I mean, disclosures are
always improved.
Always could be improved. And there's lots of specific disclosures in IFRS 3. There's also certain fair value disclosures in IFRS 13, the fair value standard, that actually aren't applicable in this kind of circumstance where you're using fair value and measuring things you acquire. But actually, ESMA particularly have urged preparers to say, well, there are certain things that aren't required for you to disclose. Please bear in mind there are overall disclosure requirements around judgments and estimates, and make sure you're disclosing enough. Picking up on sort of the board and what's happening at the board.
We know definition of a business, obviously.
Absolutely, yeah. So that will be a very big change, certainly once that comes in. The other big area that they're looking at is business combinations under common control. So where you have an acquisition that involves two entities that are ultimately controlled by the same party or parties. Because IFRS 3, as it stands right now, very specifically says those types of transactions, whilst they are acknowledged they are business combinations, they scope those types of transactions out of the standard, and you're left with this question: what do I do? And actually, coming back to the regulator point, ESMA specifically noted that this is an area where we know there isn't guidance. We'd urge companies to be clear about what policy they've applied. So as with any area in IFRS where there isn't specific guidance, the accounting policy standard says to you, well, you will need to develop an accounting policy and apply that consistently. So again, from a regulator standpoint, they are aware that people do different things with these types of transactions, and urging preparers to be transparent in their policy and obviously consistent in the policy they apply.
Yeah, again, like we keep saying it, Avni, I think we'll be having you back again, because common control definitely is a tricky one. And you see it so much in group scenarios as well.
You do.
Brilliant, thank you so much for joining us today. So we went through there some of the basics behind IFRS 3 and sort of some watch out areas that people typically miss. If you would like more information on business combinations, we've got lots on common control as well in our Manual of Accounting and on PwC Inform. Thanks for tuning in today. Happy accounting. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.